Okay, let's start then. Thanks for joining in today. I'm Giuseppe Basili, also known as the Flip Stalker. Good morning, afternoon, and evening to you. Today I'm going to provide you offer a plan to trade $10,000 in 1 million in 2 to 5 years. As much as this statement may seem a mouthful, reaching this kind of results is possible, and today I want to tell you a plan, and this is going to be very, very practical. We're going to review some charts as well. Welcome, Nick. We just started. And I hope this information is going to help you to create a realistic view of what's possible, what's not possible in trading, as well as give you a plan to follow and the skills that you will need to develop. So as you know, risk management in trading is really trader's job number one. A lot of people believe that we have to generate large gains. No, we have to generate steady gains, managing risk properly. And I'm going to review some charts. I want to make sure that you understand that this information is merely provided for general information. I'm not making trading recommendations. Why I feel I can talk about this matter. This is my biography. I started trading in 2001. In 2006, I understood the importance of mentoring. And since 2001, I collected over 20,000 hours of total market exposure. I worked with a number of mentors, Van Tarp, Ivica Jurasic in Europe, David Asley in California. And I've read the work of a lot of other brilliant technical analysts and traders like Jody Napoli. I founded flipstalkertrading.com in 2012, and recently I've started a community. It's called Winning with Algos Community. We also have a trading room and a trading signal service. I also offer twice, 3 times a year, the Flipstalker Members Coaching Program. You can jump on my newsletter. You can go to the old blog here, and I work with the CSTA. I'm a professional member of the Canadian Society of Technical Analysts, and I've been asked last June to join the National Board of Directors. I have responsibility for the Toronto region. Some of the research paper here and organization I've been working with. If you want to get more information about some of the models that I'm going to use to and show also today to model markets, you can actually go to winningwithalgos.com/start. Welcome, Abdul. Thanks for joining. And if you want, on the other hand, try for 1 month, no risk on your side, the trading signal service, you can go to winningwithalgos.com signals. These are my references and my contact information here. You can always reach me at flipstalker@gmail.com. All right, so how do we trade a relatively small amount into a very large amount in 2 to 5 years? Let me give you some information here. So the point I want to make is that we will need, and you will need to change some behaviors. So you will need to create some skills or actually establish routines in order to do that. I can speak about some of those in a series here. You can watch on FS Street, the 10 Steps to Trading Success series. I'm in the process of we completed the step 5, but you can see all the recordings if you go to my page. So there are 4 things that you will need out of these 10. There are 4 that are key. The first one is the trading edge. You have to have a method with positive expectancy. And if you don't have it, you have to either learn to trade with positive expectancy or follow someone who has a method with positive expectancy. You need to manage risk containment and risk management, as I always say, is trader's job number 1. You have to contain risk at all times. Otherwise, it's impossible to generate large returns and steady returns. The way you will reach the objective for us is in these in this presentation is going to be 1 million is to perform money management, and I'm going to present one way to do money management. And really, money management is the way we reach objectives in trading. It's not by risking more. It's not by trading more. It's by using other people's money in the right way. And finally, of course, trading, whether you follow someone or you identify your own setups and trade your own setup, you need discipline and the psychology to follow a plan. This plan may be a simple plan to follow someone else for that period of time, or to follow your own plans as you analyze and identify setups. Okay, so these are really the four key items and areas that you need to master in order to succeed. Now, if you're curious about the 10 steps, these are the 10 steps, and you can be successful with the first 5 steps by following someone else. But if you really want to reach mastery, then you have to keep learning the skills and also master steps from 6 to 10. I'm not going to focus on this now. I want to remind you, though, that trading is a business, so don't treat it as a job. It is not. It's a business, which means that you cannot expect an income. And now I'm going to show you at the end of this presentation also the results in the last 4 months we had so far since the inception of the community and the trading room. So you will see that they're very variable. The returns are variable, and it's the nature of every business. So don't force returns. That's where losses and psychological losses come in the way. It's when we try to force results, try to force a steady income. No, the market is going to offer us opportunities based on what is available. Now, I like to always, when I talk about trading as a business, to show my 7 pillars for trading in modern markets, which shows basically all the areas, 7 areas you have to focus. This area here is really the mechanics of trading. It includes the method, timing, money management, risk management, and the psychology of the market, the way the market works and moves. And an important part, 75% of it, is probably the psychology of the trader, on the other hand, which is this blue area here. But as you can see in the middle, there is an area which is called trading as a business, which keeps everything together. You have to treat trading as a business. Okay, let's start from the trading edge. As I mentioned, we need a method with positive expectancy. If you don't know what expectancy is, I'm going to clarify it in a moment. But what we need is to learn the mechanics of a robust trading method. That's key, obviously, if you want to reach consistent and you want to reach your objectives at the end of the 2 to 5 years period. Now, this is usually the component people focus the most, but as you learn in this presentation, is not the most important one. Believe it or not, the most important one is money management, as I'm going to show you later. And if you already used or use a good method, that's okay. Probably you already used a good method. Just sorry, as I told here, there's an opportunity here if you want to look at the euro versus the pound, and there is a short coming at 86.94. So a potential trade here would be to buy below 86.80 here with a stop above this 13 moving average here, just because I'm looking at the market as well, and that's not a recommendation, of course, but it's just an idea there. So you likely already used a good method. Maybe it's not a great method. The point is that it has to have some characteristics when it comes to expectancy, and we will look at that in a more detail. So the problem is maybe the reason why you were not able to use it probably is because you have not developed enough confidence and discipline to use it to generate consistent results, and that's key. That's something that you will need to develop, whether it's your own method or someone else's method. Welcome, Sandy. Then you have to develop that discipline and also that confidence. Now, when I speak about the mechanics of trading, I really mean one or more trading system to identify setups, how significant players are positioned in the market, and I'm going to show you a couple of examples here. A timing technique that allows you that you can apply on a valid setup, allows you to decide when to enter. And finally, basic position sizing, which is really how much money. A lot of people like to trade fixed lot, which I don't understand, because there is I don't understand how they manage risk. So when you trade a fixed lot, it means that you have a different percentage of your account that you are risking on each trade, which does not make sense in risk management best practices. Okay, again, now I mentioned players, and I want to introduce the two major players I follow. You might have heard about this before in my work. There are two players, and there are many of them, but there are two groups, and I model them and call them smart money and dump money. And I'm going to show you how I model them in a moment in an example I'm going to give you. The smart money, I believe they know what they're doing. They are large banks, professional traders, program trading algos. They actually establish trend on small and large time frames. And I'm going to show you an example later on. The dump money, it's really the traditional tech analysis crowd, the trend following, discretionary, and also people who enter the market believing it's easy. The trading the market, it's as easy as inserting an order, but the reality is that they don't have a clue. And I didn't have a clue when I started myself. Now, smart money and dump money do not win or lose at all the times. But what I believe, and this is very important, and I want to stress this point, that smart money initiates and leads market moves. And on the other hand, dump money obstacles or follows market moves. So often it's either wrong or late, and this is very, very important. So again, I want to stress, I believe that in order to win in this game, we have to stalk the smart money, and that's where my name comes there. And again, smart money initiates and leads, dump money obstacles and follows. If you remember this, I think you will actually master something, something that is important in terms of understanding here of how the market works. So you need to master a method. Now, before we get there, let me show you in an example here what smart money and dump money, and by the way, that the trade there has triggered, as you can see here. So this might continue lower, well into 85.19. This is the euro pound. So what I want to show here is something different. Pound versus Australian dollar. This is a trade we have taken in the trading room, and I want to show you how smart money and dump money actually have participated in the way I model it in this trade here. So first of all, as I mentioned, I model dump money with a simple technical analysis trend following, and that's the moving averages that you see there. On the other hand, I model smart money using some models that use Fibonacci in a known conventional way. I only use 4 levels of Fibonacci. The level here that we saw playing back at the end of May here, it's 206.67, was a 50% retrace from the highs of October 2015 here. So we trace from highs to lows here, and we captured this area where we could have a reversal. I never sell these areas blindly, always time them, and that's why when I spoke about the mechanics of trading, I also mentioned a timing mechanism. As you can see here, these levels are always fixed, minus 23.6% below the low here, and minus 61.8% below the low. It's not a case that this market has found a little bit of support here and then it stopped the move lower when it came into this level here. So the next measure move, which was the next area, which could potentially be participated by algos, came because because the market here was extended, came from an extension from lows to lows, and so I started looking at 170.26. That's the area where I wanted to start looking for shorts. Now look at what happened when we move to the daily here, and we put those moving average in, and I used two simple moving averages. They are the ones that are suggested by Alexander Elder, so everybody knows them, and that's the reason why I use them, because they model very well groups of traders who actually look at simple models. Now, the blue one is the 26 EMA. The thick one is the weekly EMA. The thin ones are the daily EMA. Now, look at what happened here, and this is very interesting. It gives you an idea of why it is important to monitor dump money as well. This is the level we mentioned before. This is the level where smart money could start coming in. But look at what happens when the first selling takes place here. There is dump money here, which is represented by the area between the two EMAs that keeps pushing price higher, and it pushes price higher again into that level. It's only when the dump money gets out of the way, which is here, so they keep pushing this price high initially, then after this test they keep pushing price higher, and they keep pushing price higher here, but at some point this area between the 13 and 26 EMA it's not capable of pushing this price higher any longer. So at this point, only smart money, which initiates and leads trends, is capable of pushing this price lower. We took a position and we brought this market into 166.60. The market went much lower, but we captured almost a 5 unit of risk in gains in this trade. Okay, so this is a demonstration of those two concepts that I mentioned: the smart money, the dump money, the way I use it. There's much more to that, of course. And remember always, the smart money initiates and leads, while dump money obstacle and follows. Smart money initiates and leads the move lower. Dump money actually it keeps pushing price higher until it doesn't, so it obstacles price. It's a question that if both smart money and dump money are selling, when, then who's buying? Great question there, Abdul. And in fact, that's exactly when you get those move US dollar Japanese yen here. I can show you an example on the weekly where smart money and dump money were both agreeing, and it's a great question. And when we put in the trend following here, we can see here that there are some areas whereas dump money and smart money are both in selling mode. For example, here there's a 50% retrace. Smart money selling, dump money, as you can see, the 13 is below the 26 here. Although this price goes above that area, this is selling for dump money. Look at what happens when both smart and dump money agree. And the same happens in this very technical market, is US dollar Japanese yen, but happens in other markets as well, here and then here. And again, see and look at how the first and second target are usually very well respected, because smart money is going to take algos, are going to take profits out of these markets here. Okay, great question. The other question is, Al, where do you learn how to properly use Fibonacci? Well, there are different ways of using Fibonacci. I believe that the traditional way of using it does not work, meaning that there is too much indecision which level you should use. I learned this method from a few mentors, and I actually improved it. So, you can look around on books to learn the traditional way of using Fibonacci. But if you want to learn more about this specific way of using Fibonacci, you can contact me or you can join the Historical Methods Coaching Program. So let's continue here. So it's very important to master a method, and you have to also master ways to measure how effective a method is. Reliability is definitely one of the measures, not enough. Expectancy, it's the dollar gain in average for each dollar risked. And this is true also for losers trades. So if you have a loser, what you do, you average winners and losers, and you actually calculate how many dollars you make for each dollar that you risk. And this applies to both winners and losers as well. This is a very, very important measure, and it would be nice to have an expectancy 1 or higher. The frequency, which is the number of opportunities that you get in a month or in a period, is also very important. And expectunity is expectancy times the number of opportunities you have. Okay. Now, your performance will improve when you start measuring, so it's very important that you measure as well. And this simple measure to not only give you an idea of how good your method is, but also give you an idea of what you can do to improve in your trading. Okay, so of course the key of a good method is not high reliability but high expectancy. The expectancy has to be high. The fact that system will have an high expectancy doesn't mean that it's not going to produce losses. Losses are a fact of life and a fact of trading as well. Okay, so now here is an example of when you measure after the fact setups in the Fibonacci methods or Fibonacci signal. That's what you get. But I will give even a more realistic view. I will do a reality check of this. But typically, in average, you'll have 60% winners with 2.5 average win and 40% losers. And when you lose around 1 unit of risk. Okay, so the number of opportunities, it really depends on the number of markets you also follow. So this is not very important. We can get between 10 to 20 opportunities per month, only trading the daily and 4 hour. The expectancy that you can measure is a little bit larger than 1 with an expectancy of around 7. Now, this is what you measure, but in practice, what you get is it's slightly different. I'm going to show you at the end of this. At the end of this presentation here. So the second important area, it's risk management, and I like to think about risk management parachutes. Trading is all about risk. If you hear something different, be very careful. The market can do anything. So risk containment is job number 1. As soon as you start assuming what the market should do next, you will get yourself in big trouble. So what are my risk management parachutes? How I do perform risk management? Risk management is not only risking a small percentage of your account. This is called fixed fraction risk, and it's I like to use 1%, and I'll show you how by using money management we can actually reach our objectives. I use hard stops, not soft stops. A lot of people use soft stops. That's not the way to go, especially forex trading where volatility can be very, very high. I only trade in low risk areas. For example, when we spoke about our pound Australian dollar here trade, this was a low risk area here. Okay, and just give me a moment here. Can you hear me here? Okay, good. So this was a low-risk area because there was potential participation from short smart money, and Um, and also a lot of people here in this chart here, a lot of people who see this move higher, like dump money on the smaller time frame. They want to keep buying this price, but that's exactly the concept of bandwagon theory. Everybody wants to get in the bandwagon, and they do it the exact wrong time, and that's why smart money are able to, and our algorithms are able to source volume right in those areas. I adopt a risk-free approach, which is exiting half of the position when I get 1 unit of risk in gains. You can apply or not, and of course the results are going to be very different. You will reduce your losses. You will have more scratched trades. I wait for testing of area of participation, and those are the Phipps Stalker levels, like the one I showed you in the pound versus Australian dollar. I also wait for confirmation, and time frame always wins. The time frame in this case was short. The larger time frame on the weekly was trying to short this market, and what we did, we went with a larger time frame, which always wins. Of course, we have to time and wait for confirmation. And also make sure that there is enough room for price. For example, in this trade, there was nothing below price. Price could go back to 159 and almost did it without, because there was nothing stopping this price from doing so. And finally, accepting risk. A lot of people put up a trade, but they really do not accept the risk, which means that they never take into consideration the fact that the price could go against them. Other ways to manage risk. Trading is a process, and it's a process of elimination. So very often we are excited, we want to trade everything. The reality is that we have to filter out what makes sense and has a high probability of working with, and what does not make sense. So in order to do that, I follow a process that I used to analyze price, and that's part of my coaching program as well as perform price discovery. So this allows me to filter out low probability opportunities. Proper money management, which is key. I'm going to show you in the next section here how we're going to reach objectives money management. You absolutely have to stay away from intuitive sizing, Joros, click criterion, optimal F, and percentage risk based on winning percentage. These all do not make sense because they do not consider the simple principle that anything can happen in the market. And if you start creating statistics on top of what you observed so far, well, I can tell you, you have not seen it all. You have not seen the worst yet. So. And most importantly, do not fail to eliminate this. Make sure that you don't have this, that you do not follow risk management. You have to follow risk management best practices all the time. You do not have to increase risk after a streak of winner or losers. Never revenge trading, trying to make money, take that money amount back, and not respecting the market. Psychological losses, not respecting the hard stops, for example. And of course, with time, you need to develop proper execution. Now, the third area that I mentioned is money management. Why so important? If there is, Van Tarp said, if you reach trading objectives with money management, and Van Tarp, I study money management a lot. I've studied money management as part of my thesis in finance, master thesis in finance. And the point here I want to make is that in money management is the most important thing in your trading. It's not the method, believe it or not. If you risk 1% of your account and you're able to make 5 units of risk per month, you can generate large profit in a reasonable small amount of time using what? Money management. How do you do that? You leverage the power of other people's money, which is really the money that you extract from the market. So you leverage the gains from the market. There is a method I call, well, actually Van Tarp calls markets money layers, which is very, very useful. The concept is very simple. You accumulate gains and you take large and larger risk on the gains that you accumulated, which is the money that you extracted from the market. When you do this, you can keep rising 1%. You can pick risking 1% on your own money and then risk 2, 3, 4, 5% on markets money. Of course, that's just a way to redistribute risk and look at the way you risk in a different way, because obviously you are taking slightly larger risk. In fact, you're taking a risk that go from 1% to 4.6% on your account. But in case a disaster strikes in, if you lose a -10, a -20 times your risk, then you will still protect your own capital, and you will risk more on capital that you have extracted from the market. When you do that, I think you gain an understanding of what is the truly trading secret. If there is a trading secret, that's money management. There are conflict of interest in the industry, a lot of literacy, and you end up trading large position or fixed lot, and that's not the way to reach objectives. The way to reach objective is to use money management in a creative and effective way. And again, market money layers is one of the examples that I'm going to show you. So what is really what's really this? So I prepared here a table where we have we start from $10,000. This is year one, and we have 5 units of risk in gains per month. And we're going to be a little bit more aggressive to obtain results, but I'll show you later how you can relax this percentage. So the idea here is that we start from 10,000, and our first layer is $10,000. And on that layer, in each trade, we risk 3%. So as you can see here, as we risk 3%, we start accumulating gains, and at the end of the month 8 of the first year, we have now $20,500. Of course, here the assumption being made is that we are able to consistently generate this. As we will see in practice, we will not be able to consistently generate this. And some months we will have 15 units of risk, other months we'll have 2 units of risk. And of course, we try to have no negative months. But even so, there is a kind of path dependency of what are going to be these final results, meaning that it will also depend on how we generate these 5 unit of risk every month, whether we lose, win, or win, lose. And so depending on what is called the R multiple that you generate with your trading every month, these numbers might be slightly different. Of course, this is just a reference. So the actual number can go above or below. And I'm going to show you some example of actual numbers. So when we risk 3% on these layers, at the end of month 8 here, we have 20,000. So we have a second layer of $10,000 here on which we can risk 5%. That's the main idea. As we generate more and more layers, these are layers of 10,000 each. For example, month 11, we have 32,500, the beginning of it. So we can start risking. And again, these numbers are very aggressive here. They don't need to be aggressive. The reason why they're aggressive is that by having more aggressive numbers, we can actually reach objectives more easily. Of course, I'm not considering taxes here. If you're able to not pay taxes or absorb taxes, not pay, of course, but absorb them by paying them with savings, then you can reach almost 50,000 here, so 400% in at the end of the first year. Can you see here how the risk changes? 3% initially, and it goes to 4.6, 4.5, and it oscillates as we create more and more layers. Here too, we did an additional layer. We added the first layer 1%, so we kind of bring back and scale back risk here. And as soon as we reach 120 here, we can scale risk back, and we add a layer with 1%. Okay, so as you can see, this is very aggressive, but with such aggressive plan, you can get to that result in 3 years. Obviously, these are very, very aggressive numbers. More realistic numbers would be 1, 2, 3, and 4, or 5, and that obviously, when you do that, the amount of time that is needed grows as well. So that's an example of how to use money layers, and the layers are these colored layers here that you see, where for each layers we only risk 1% or 3% or 5% or 7%. So just to make an example here to understand, when we are here, month 11, we risk 3% on the first layer of 10,000, 5% on the second layer of 10,000, and 7% on the seven layers. So we risk $300 plus $500 plus $700, which is $1,500 here, which is 4.6% of the amount we have in the account. Okay, so that's the way you calculate your risk. So I hope this makes sense and you can play with this number. The idea here is to show you that you can risk more or different percentage of your account on different layers. And the good news is that if something bad hit, let's say you have let's say 10 times your risk, you lose 50%, but you only lose 50% on this layer. In this case, you lose 70%, but only on this layer. And on this layer here, you will only lose 30%. Okay, which means that if something bad happens, you're still in the game. You still have money to recover. Of course, the lower is this risk, and the better is the probability. The higher is the lower is the probability of ruin. Okay, and that's why it's very important that you have a method that has an edge. So we looked at the numbers here, the proof that what I'm saying is in the numbers. And again, what we want to handle is always risk. We want to make sure that by layering, not only we have an opportunity to increase our risk, but we increase our risk in an asymmetric way, so that we increase risk more on money that we extract from the market. Okay, so that's the whole concept. It's a different way of thinking about risk and making sure that you have enough capital if something bad happens. And things happens in trading. Okay, so we have to be realistic. Now, another reality check here I want to make on the metrics, and I will use the metrics of the Flipstock Signal Service. This is audited. I have almost 40 people at the moment. So these are the results that we got in the last 4 months since inception, basically, which was October 2016. So the first number here is the return full risk. The second number is when we use a risk-free approach. Now, this is to show that because trading is a business, we can have great months like in October when we started, and we can have the small months like in December, with an average that will be around, at the moment, it's around those levels that would help us reaching these objectives. And it's also important to say that this is when you measure things on paper, but the reality is totally different. The reality is that typically you have 20 to 30% winners, and usually they have 2 to 5 units of risks, and then you have a lot of scratched. I personally have a lot of scratched because I manage risk very, very strictly. So there is something here that is not showed. So these are the winner. These are the losers, but there are a lot of scratches, and I get 40% of scratches, sometimes more. And then there is another 20, 30% of losers, and the losers typically, lose only 1 unit of risk. So this is an important reality check. That's what happens in practice, and that's the reason you cannot consider trading a source of income, but it's really a business. Sometimes there will be months in which you will do very, very well. There'll be months in which the results will be dismal. One of my objectives in trading is always to have positive months, and these are trades I take and trades I recommend, and actually have my traders and students trading as well. Now, when we calculate an average of the full risk return here, we get 6.45%, which is aligned with that 5 unit of risk that we need. And when we calculate an average of the risk-free returns, we get almost 5. So we are around that level. Okay, so this gives you an idea in practice when you trade what happens. Now, this is only the performance that I measure and report. Now, and this is obtained through the trading ideas, trading signals. In my service, I also offer trading ideas. And usually we report between 10 to 20 units of risk in gains for the trading ideas. There are many more. And obviously, it's not possible to track all of them. You will find these and the related trades on the website as well. Okay. So any questions so far? I'm about to conclude here. I hope this was interesting. If you want to try the signals, you can come to and try 1 month no risk on your site at winningwithalgorithms.com/signals. And the conclusion I want to make here is that, again, risk management and not generating high gain is really job number one. Because if you do not believe this, then you might not be be considering the reality of trading. Alice, interesting approach. Really like your webinar. Thanks a lot, Al. If you want to learn more, just contact me. We do not reach trading objectives and we don't reach trading success by taking higher risks, but what we do, we adopt a trading edge that allows us to consistently make small gains, and then we use conservative money management techniques to increase profits. That's our approach here. Okay, so I showed you an edge that gives us what we have to do. Small gains, 5 units of risk per month. It's enough, because then when we can do consistently small gains, we use money management. I showed you an example again of money management and using money management layers. Of course, at some point you'll become very aggressive. And I know no one who has, I don't know one who has more than 300,000 on a Forex account. When you start growing the account, then you're going to move into futures, and your choice becomes much more limited. You only have the majors and New Zealand dollar, US dollar. So we use money management in order to reach those objectives. We use an effective and, in a way, defensive technique, because it's true that when disaster strikes, you're going to lose a lot of the money in the layers where you have a higher risk. For example, 7% or 5%. It's quite a high risk, right? And you don't need that. But eventually, small returns of 5 a month and 2-3 layers, we can obtain interesting returns in 2 to 5 years. And I say 5 years is because if we relax a little bit, if we're less aggressive and we start doing 1, 2, 3, and 4, and what is much less, we will need more time to generate those results. So finally, money management, along with a conservative approach, a good trading edge, and when you commit resources, which is really time and money, this allows growing small capitals to amount which enable lifestyle changes in 2 to 5 years. Nick, thanks a lot for your comment. Abdul, no one's teach these important lessons like you do. Thank you. You're very welcome. And there's a lot of hype in this industry. Let's be honest. When people are focusing on selling and not focusing on what is important, that's what happens. So, of course, I have my own service. I have my own coaching program. This is also one way I get students and traders. I like coaching, and Abdul knows that very well. and that's the reason why it's important to focus on the important things. So if you are interested and you want to get more information, you can always reach me at fullstocketrading.com and drop me an email if you're interested. I'm also I started enrolling for my new coaching program session in March. It's going to be the sixth one. The sixth one has been very successful so far, and many traders are reaching their objectives. So thank you, Abdul, Adam, Al, Joseph, Nick, Sandy, for being here today. I hope you found this interesting and informative, and most importantly, something that can put you back on the right path and gives you an idea of, in practice, what really the trading business is. So thank you and have a great day. Bye now. If you have any questions, you can always find me on fipstalker@gmail.com. Okay. Thank you very much. Bye bye now.